Hey guys, welcome to Mentorship Monday. My name is Matt and I'm with the DeRosa Group, and you are watching our Mentorship Monday episode. This is a series for us answering questions submitted to helpme@DeRosaGroup.com. That is helpme@DeRosaGroup.com. Folks are emailing in questions to that email address, which you guys can do too. helpme@DeRosaGroup. Just shoot in your real estate questions, and one of us will answer them right here on the YouTube channel for your real estate education. Today I've got two questions. First one is from Mitchell from Lansing, Michigan. Thank you, Mitchell, for submitting a question. What Mitchell wants to know, this is a good question because you hear a lot of people talk about this. Mitchell wants me to briefly go through the explanation of how you rate a neighborhood, because I'm hearing people talk about, oh, this is an A neighborhood, B, C, or a D neighborhood, and some people would even joke that you can go down to F or G or H or I for really, really bad neighborhoods. So here is my understanding, and there's different understandings of it, but this is the rating scale that I use for my business, and I think it pretty much flows into what's out there. But the short answer, Mitchell, is it's somewhat subject to interpretation, but here's my interpretation of it, okay? So an A-level neighborhood is a neighborhood where rents are at a premium, not even neighborhood, just an A-level building / neighborhood or whatever, is a neighborhood or a building where, compared to the regional market, that building's rents are considered to be a premium. This is a luxury building where you're getting premium rents, and there's probably a lot of home ownership around the building, and it's a premium product, probably a brand newly built apartment building, or in a really, really ritzy high-end build, like anything in Manhattan or New York City. Basis the rents that are there would be considered A-level property, because it's just high-end luxury product that arguably could not go much further up, and there's just not much room to do value-add stuff. So investments like that are probably not going to yield much cash flow. There is a bet that you're placing that it's going to go up in appreciation, not a guarantee. Probably hard to juice the lemon, as they say, to get further profitability out of the property, and you might be paying really low cap rates. Like in Manhattan, you might be paying 3 or 4% cap rate for the privilege to invest in properties in that area, in the hope that it might go up in value in the future. I do not invest in A-level neighborhoods. There's plenty of people that do, and there's nothing wrong with that. But it's hard to go much higher up on cap rates, or much on increasing rents, or on doing value-add improvements to the building. But it's a good place to park money and not get a whole lot of return, and hope that you're going to get appreciation on it, right? So that's A. B-level property is, it's more, there's still some home ownership around the building. You're still going to see a smidge above the market, maybe at or above the market in rents and in income for people that are living there. Probably some white-collar, executive-level folks that are living in the building. Towards the higher end of the average of the rents in the area. Some home ownership. Now a B, you can still take it up to a C property. To an A property. And you heard people talk about like a B plus or a B minus in an area where those are just ranges of the B. But again, that's kind of towards the median of the property price, median of the income of the area, median of a lot of different things. It's kind of towards the middle. Okay. Now a C is what they call workforce housing. It's people that are blue collar folks that are making anywhere between, say, 30 to 50 grand a year. You need to have that kind of housing in any market. There needs to be people that are doing that level of work in just contributions to the workforce. It might not be the nicest complex, might have a pool, maybe a little bit dated, might need some facelifts or something like that, and you might have a lot less home ownership around the building, not in the building, of course, but just in the neighborhood around it, and the rents and the income in the property might be a bit below the median average of the greater region around the property. So the investments I like to make are properties that are C properties in areas that are there where there's a little bit not too heavy of a jump to take them from C to B level properties, or to just raise rents a bit to increase the quality of living in the building. Well, that's just completely evicting everybody, but just to keep maybe most of the tenant base that's there, and see if they can afford another $100, $150 a month in rent for a much more premium product of property for them. That's my favorite investment. I think a lot of other people like to do that too, but that's the target for most investors, is to find C-level property to take them up to a B, or even to take a C plus up to a B minus or something like that. And then you got your D-level property. Those are more areas where you're going to see, not that you don't see crime in A, B, and C properties or A, B, and C neighborhoods. It's there, I'm sure, but there's a higher crime rate in D-level properties. You're probably going to see a lot of some sort of subsidized housing. It's well below the median income. You might even have folks that are just not even working per se, but all on support levels and stuff like that in areas like that. You can do really well investing in D-level properties, but some investors don't do it because of the crime element that you can have in areas like that. But you can also take a D and bring it up to a C by cleaning out a lot of the crime element, because nobody wants an element like that in their building. So you could do that and bring it up to a C and probably add some value, and you add a lot of value to your building by just doing some, sleeves rolling up and managing and bringing it up from a D to a C. There's the biggest thing in buying and investing in D-level properties, and again, there's nothing wrong with it, and there's no judgment that I have on people that own or that live in D-level properties. It just is what it is. It's just that type of property is required in the society that we have, but you have to have really good management to make sure that the tenants that are there are not just getting a better way, because it might be hard for them sometimes because of the income level that they're at. They might be tight on their income. It might be harder for them to get the rent in on time. And unfortunately, because of the crime element, you got to have somebody that really has their eye on the property. So property management is the key part of a D-level property. It's very important in all of them, but for D-level property management is off the charts, the most important thing you have to have in that. So I hope that answers A, B, C, D. Again, those are my definitions of it. But just the things you want to relate it to are the median income for the area, and use words like luxury and high-end for the A stuff, and more workforce stuff for the C. And for the D, obviously, that's just going to be your lower income stuff that might have a little bit of a crime element mixed into it that has an opportunity perhaps to raise it up too. So, so that's that for the scale. So thank you very much, Mitchell, for asking a question to help me at DeRosa Group. Next question is from David from Midland, Texas. David, thank you for asking your question to help me at DeRosa Group. David wants to know, with the minimum amount of units that I would buy in an apartment complex, can I explain cap rate percentage? Well, cap rate's a whole big thing. There's actually, what I'll do for you, David, is I will post a video down below where I explain some of the real estate terms, including cap rate, and you can check that video out. And David also wants to know, is it best to create an LLC for every apartment, or you buy or just one? So it really all flows into one answer, David. It depends on your goals, okay? It depends on the goals that you have, and if you're buying with your own money versus buying with investors that are investing with you, it depends on the goals that you set out for. I've bought 10-unit apartment complexes. I've bought stuff in the mid 40s to 50-unit apartment complexes, and I'm now targeting larger units. But it also depends. Just for me, it depends on the goals that I put forth for myself, for where I want to go, and that I put forth to my investors. I even own single-family homes, but that's where I was at that point when I was buying those. So you need to sit down and figure out where you want to go with your financial goals. And if you're putting in your own cash, then you're the only one that decides how big you want to go. If you're bringing in investors that are investing their own dollars with you, then you need to talk to them about what kind of cash on cash they want to see, how long of a hold that they want to be in the properties for, and just all the factors that will help you determine things like the market you want to be in, the other conversation we just had about whether or not you guys want to get into A, B, C, or D level properties, and obviously how many units you want to get yourself into. You asked about cap rate. You asked a lot of questions about how many years would it take for you to get your money back. Again, that has to do with cap rate, and that has to do with the cash-on-cash return that you and your investors are looking for. But what I really think that you need to do, David, just in reading all of your questions here, is you need to sit down and write out your 1, 3, and 5-year goals for where you want to be in your real estate holding business. Talk about income, talk about unit size, talk about geography and everything like that, and get really, really flat on that, and it will float to the top how big of a building you're supposed to be looking for, because it's not a straight answer. I can't just say you should be seeking a 20-unit apartment building, David, because I don't know enough about where your goals are, and there's no right answer to that question. For one person, a 20-unit apartment complex is the perfect thing that they should be seeking. For another person, they should be looking for a 100-unit apartment complex. And for another person, they should be looking at single-family homes. So I wish I could make it real simple for you and tell you what size building you should be looking for, David, but it's just not that simple. So set yourself some goals, 1-, 3-, and 5-year goals for where you want to go, and then start laying down an action plan on what it's going to take to get you there, and then lay out your investors and who's going to finance you to get to where you want to go and everything like that too. So anyway, thank you, David, from Midland, Texas. I really appreciate your question. Thank you, Mitchell from Lansing, Michigan. This is a longer episode of Mentorship Monday, but there was some really good meaty stuff in here. I hope you guys got something out of it. Don't forget to email helpme@DeRosaGroup.com. That's helpme@DeRosaGroup.com. If you've got any further questions you'd like for us to answer here on the YouTube channel. Thank you so much for watching, guys, and hope you have a great and profitable week.